Hello, everyone, and welcome once again to a VNE webinar. Today, I'm joined by two old friends who've actually been on these podcasts before. The first is Chris Weafer. He's the founder and CEO of Macro Advisor, which is a consulting house talking about business economics in the former Soviet Union space and Russia in particular. He's also former head of research at pretty much every investment bank, both Russian and international in Moscow. He's been doing it for many years. Also by Christoph Ruhl. He is now senior research scholar at the Center of Global Energy Policy with Columbia University and a former chief economist at BP. And I always forget which one it is. Is it the World Bank or the IMF?
It was the World Bank.
The World Bank, yes. Chief economist for Russia at the World Bank, where we first met many years ago. And we're going to today dive in and talk about the whole oil situation. So before we get started, a bit of housekeeping. For those who want, if you use the chat function, you can ask questions as we go. We'll try and answer them as they come up. I can ask both Chris and Christoph to keep an eye on the chats, the questions, and if you see anything relevant, please pick it up and throw it into the conversation. And also, you can find at the end of this links to a recorded version on YouTube via bne.eu/welcome. There is also links to things like, I recommend you sign up for our editor's picks. It's our daily digest of our best stories the last 24 hours, which is free to read. And if you're in the game and want more of this sort of information in more detail, then we report daily on our premium pro service. And again, you can sign up for a 2-week trial at bne.eu/welcome. So, gentlemen, let's dive in. Oil is the sanctions are probably the most serious sanctions that Russia faces, in so much as the idea is to sanction them in such a way as to cut the Kremlin off from its cash cow. But at the same time, not to disrupt the flow of oil into the market and cause a shortage and then spike the prices. And the oil sanctions only came into effect the first round in December the 5th, where there was an embargo and the introduction of the price cap, which capped prices at $60. We'll talk more about that in a minute. And of course, on February 5th, those sanctions were extended to include oil products, things like diesel fuel, kerosene. And looking back over the last year, the sanctioning of oil, the self-sanctioning of oil started almost immediately, in so much as traders, although oil was not sanctioned at the beginning of the war, traders then would not touch Russian oil. And for the first 2 months, the oil started piling up. Then as the year wore on, the market did its thing, and most of the oil, I think all of the oil that was going to the EU ended up going to India and China. And India in particular had never bought much Russian oil at all, and now it's one of the biggest buyers. The Chinese too were buying. I mean, they tried to cap the oil from individual suppliers to 15%, but they sort of abandoned that and opportunistically started buying this oil because it was deeply discounted. And as far as I understand, they absorbed all of the EU oil. And at the beginning of the year, I mean, I think even the Russian position was that production was going to go down by some 15%. And as far as I know, by the end of the year, actually, Russia produced more oil than it did in 2021. Is that fair? I mean, can we say that the sanctions or the self-sanctioning that have not affected, that all that's happened is there's been a rerouting of a remake of the market where Russia no longer sells oil to Europe, but instead now sells it in Asia? Talking about crude here. I don't know. Who wants to go first?
Well, let me jump in. First of all, I should say to anybody, you don't need to adjust your screen. I've off for a few days and I stupidly went out in a boat, so I look like a beetroot. So it's sorry if it's blaring at you. Yeah, look, I think last year was a huge learning curve for everybody. Expectations, which traders, the oil market, which even Russia had at the start of sanctions, all had to change and were changed as we went through the year. So as you say quite rightly, there was initially a big slump in trade with Russian prices, but pretty soon picked up. So what we saw for most of last year, on the one hand, was kind of oil customers and traders in Europe buying as much crude and particularly oil products as they could from Russia in anticipation of the sanctions, the bans that were coming, you say, December the 5th for crude, February the 5th for diesel. So we had a huge surge. And that, of course, led to almost a windfall in terms of oil export revenues for Russia last year. We saw that the trade surplus was $280 billion, up from 190 the year before. And because there was a huge scramble to buy crude and particularly products from Russia before the bans kicked in. Now, in terms of the crude, we have seen a lot of that crude go to Asian markets. You say India in particular has been a big buyer, and Russia has been able to do a lot of that. It's been able to get tankers. It's been able to increase trade in some routes, but really that's now changing. I think this the summary picture here is that last year Russia was in a strong position and able to divert almost all the crude it lost to Europe to the Asian markets, and there were strong kind of European buyers for products, etc., ahead of the bans. Now we have a different situation where both those bans are in place. And there is an infrastructure problem. The 2.8 million barrels of product, 50% of which was diesel, which stopped coming to Europe from the 5th of February. Absolutely, but by no means all of that can get to any other market because there isn't the means to deliver it in terms of tanker or rail cars or pipelines. Russia has been scrambling to buy tankers, as we know. There's been a lot in that in the media about the so-called grey tankers. But it physically will not be able to shift that product. And that's why we've heard from Deputy Prime Minister Mr. Novak saying that oil production will go down by 500,000 barrels a day on average in March. They're waiting to see exactly how much of the oil they will be able to divert the product and what will be the impact. And we're not going to get a clearer picture of this for several more months. What you can say is that there is going to be a drop. We calculate somewhere between 1 million barrels and 1.5 million barrels Russia will lose from exports and therefore from production. And the reason is not a lack of customers. The reason is they will not be able to shift it or deliver it to other markets because of infrastructure.
I want to drill into the ghost fleets in a minute, and also the issue of the pipelines. But first, I was looking specifically at production, and if I remember correctly, when, today, a year ago, just before the war started, Russia was producing about 11 million barrels a day, which was near its all-time high. And the production at the moment, given the self-sanctioning that's going on and the remake of the market, we're still at 11 million, or I think they just reported 10.25 for January. But is that right, Chris? The production so far is held up.
It has held up because there was an enormous scramble for diesel ahead of the February the 5th. Russia was exporting record volumes of diesel to Europe and other products to Europe ahead of the ban, 2.8 million barrels on average a day for almost 6 months up to January. And also, I say, the crude successfully shifting a lot of that to Asia, to India, and to other markets. So really, it is February. The February numbers, the March numbers is where you're going to see the big drop, or we're going to see what is the impact of the accumulation of these two sanctions. It's only then, because up to this point, up to the end of January, everybody was scrambling for Russian oil, and Russia was able to divert it. But that really has changed from the beginning of February, and we simply don't know to what extent yet until we see probably the March numbers rather than even the February numbers. So coming into April, we'll have a much clearer picture. We'll be able to assess what the impact in terms of the budget is, and then we'll have a better picture of what Russia's kind of stability in terms of funding and the economic outlook will be, and not before that.
Christoph, what's your take? Because when we talked about this, it was just after the war started, and we were talking about wartime economy mentality, and with the outlook for the oil, particularly for the discounts, we were saying then that they're going to be heavily discounted. And however, it seems that the discounts did appear immediately after the war started with the self-sanctioning. It blew out to something like $35 from between Urals and Brent from the traditional $2 discount that Urals used to have. But then looking at the November numbers for India in particular, there was no discount at all. And I think it was either Novak or one of the other ministers came out and said that even now in January, there's no discount for oil that's headed to Asia. Didn't it all go a lot better for Russia than we expected?
I'm not so sure. I mean, it goes slower than we have expected. But I think when you have this kind of maze of detail, then I'm a great friend of trying to step back and just get some order in it. And what you said initially, that we faced a huge learning curve, is in this whole sanction business nowhere more true than in the oil market. And remember what happened when Russia actually started the military invasion, which surprised most people. There was an economic sanctions program prepared. So this terminus of economic warfare is completely justified here. And a key section of that were sanctions. And they were implemented immediately, mostly in the financial sector, but not in energy, not in oil, not in gas, not in coal initially. That was because nobody really had any experience. Here was like more than 50% of global GDP, which is the G7 plus European Union plus assorted allies like Australia or Japan, or like Australia. More than 50% of global GDP against about 12-13% of commercially traded energy. Completely unprecedented situation. Of course, the 50+% GDP need the 12+% energy to be produced, right? And then we started learning. The first effect was the discount. That was not something which was intended or many people had on the radar. It happened very quickly, and it was very clear why it happened. And this is a risk premium. It's like you said, traders not wanting initially to touch Russian oil exports with a long pole because we don't know about the juridical, the financial, and the reputational impact that has. So the discount started to widen, and you can track it over the year. To your question, it narrows when the situation stabilizes and becomes more clear, and it widens if another dose of uncertainty is introduced, either in economic sanctions or even in the military situation. So that discovery of the discount was the second one. Then the third thing which we learned is initially when there was talk about oil sanctions, in particular in Europe, it was always part of the game to cut Russian export volumes and not just prices. And the reason for that was the experience of the collapse of the Soviet Union and the different nature of ex-Soviet or Russian fields, which are very different from fields in the Middle East in the sense that you need a multitude of small wells to produce the oil, not one or two big ones, and that you cannot scale them so easily. So the experience from the Soviet Union was that once it collapsed, production capacity is damaged by higher water cut, by freezing over, by erosion, by all sorts of things. So that it took, in this case, more than 25 years and a huge amount of Western capital and technology to bring them back up to pre-Soviet production levels. And it is true at the other extreme in 2020 with COVID, we know Russian production declined by 2 million and came up in no time. So that was not a damage in production capacity, but somewhere between these two extremes lies a red line. When you cross it, Russian capacity is permanently damaged. And initially, it was part of the sanctions concept to get to this point. That was quickly given up when prices sort of started initially to go up. And when the insight sort of got a foothold, in particular in the US, that they didn't want to risk paying for the sanctions, so to speak, by higher oil prices. And that was when this idea started to be floated. Maybe we can just attack the prices the Russians get by widening or stabilizing the discount. And we don't have to bring down volumes to the same extent. And maybe this way we can have our lunch and eat it too by having lower revenues for Russia, but lower overall oil prices. And that was the marriage of the American idea of a price cap with the European sort of not thought through courage in cutting oil. The price cap itself is not a particular brilliant idea. I don't think you usually get punished for the law of unintended consequences if you introduce multiple prices for the same product. But here it was never tested. And instead the market, as you said, did its thing. It has very little to do with that self-sanctioning. It was just a redirecting of the trade flows, which happened more or less effectively. And I think when we now, this was in response to the crude oil embargo, when we now look at products, I don't think that will cause a problem at all, because a little discussed provision in that embargo of the European Union says that when the crude is blended and contains Russian crude and crude from somewhere else in a third country, that the resulting products are not subject to an embargo. And it does not specify how large the Russian share might be. So in addition to the usual redirection, which we are seeing now, we will find a lot of these products continue to go to Europe first into the Middle East and then relabeled and back to Europe. And also it helps to last for in that game that you can chemically test a tanker full of crude oil and you can determine very closely where it comes from. Right. You can't do the same with products. It's basically anonymous.
Can I ask maybe what's a stupid question? Because it seems to me, going into the sanctions that you immediately think, stop Russia from selling oil, but actually that's not the goal here. And the way it's been structured means that you have in effect changed the makeup of the market of where the oil goes. Because if you take, for example, the oil that's been sent to India, and Americans have banned the import of Russian oil products, but the Indians are just refining it, and then their exports to America have soared. And all you've done is introduce this dogleg in the process, whereby you could have sent the crude straight to the States and they would have refined it. Now you have to send it to India and then it goes to the States. And then they're buying, in effect, Russian oil, but then they're not because they've sanctioned it, so you can't do it directly. And all this is it's a massive distortion. But at the end of the day, you're still buying Russian oil, aren't you? Go ahead.
Yes, and then what it does, it increases transaction costs for everyone. And at the end of the day, as you said, you still buy Russian oil. Now, there are two very, very, very big questions at the moment still open. If we accept this story that the market has done its thing and successfully redirected this and just increased the transactions for all of us, otherwise not much has changed. Still too much.
So it becomes a tax, doesn't it? I mean, it's effectively the sanctions are a tax.
It becomes a tax on consumers. It also becomes a source of comparative advantage for those countries who get the cheaper oil, India and China, compared to those countries who pay the world market price, the Brent price equivalent, like Europe and the US. But here are two questions which are, I think, of great importance if we accept this kind of general storyline. Number one, China consumes about 15 million barrels per day, India maybe 5. India exports everything. China has some almost 4 domestic production, but emerging markets just in Asia account for about 30 million barrels. So there's enough poor countries. There's Pakistan, there's Bangladesh, there's Thailand, there's Indonesia, there's Vietnam, and enough markets which could have been used and could still be used by Russia to bring down the discount, to start a bit of a bidding war. Why did that never happen? That's one big and very good question. So people would say, infrastructure bottlenecks, not true. They do the numbers, there are landing points, there are loading points, there are pipelines. People would say they can't take the crude, they don't have refining capacity, not true. Many of these countries have a good mix between refining capacity and crude import capacity. They can deal with both products. It hasn't happened. People say maybe not enough connections, no trading system in Russia. All of that is true, but over time it would adjust. And the other big explanation is that Russia actually didn't want to completely eliminate the discount to China and India for political reasons. So they are sort of willing to some extent keep the cooperation with these two countries alive by foregoing some of the revenues. That's a conspiracy. I have no evidence of that, but this one. And the second big question is the $500,000 barrel cut, which Chris has mentioned. Is that really because the oil comes out of their ears and the redirection takes time and there's too much, and so they have to scale down production a little bit? Or is that a prelude to something which I could see if Russia stands with the back to the wall and gets into military trouble, which is to use the oil price as a weapon to divide the coalition and to bring about an economic crisis in the West? I make it a bit provocative. These are the two main questions to which no one at the moment seems to have an answer.
So just before we get on to the production cut and that question, which is being debated a lot at the moment, hasn't this sanctions failed in so much as Russia still can sell its oil? The market is just adjusted and you've introduced these dog legs, which is a tax, but at the end of the day, it's us who are paying the costs because, as you say, the cost of shipping, you used to be able to send from Primorsk to Rotterdam, it takes a few days. And now you've got to send a tanker for 2 months all the way to Asia and back in order to carry the same oil, which ends up on the same market to the same consumers. And we, the consumers here in Europe, are paying the extra of those transport costs. And so, go ahead.
To me, they have not failed. To me, the sanctions, the relevant comparator is not to say that Russia made more money in 22 than in 21. The relevant comparator is to say after the war, the Brent price jumped and Russia would have made a huge amount of money without the discount. And because of the discount, their increase from the situation, which in revenues was actually quite minor. And so to that extent, the sanctions have worked and continue to work because there's still enough oil in the world bringing down the price. But it's true that the sanctions have not worked as well as they could have if the West would have been prepared to also address volume cuts. And they haven't. And the reason they haven't is that they were afraid of high oil prices. And so we are sort of right in the middle now. Energy sanctions kicking in very late, oil sanctions kicking in the latest. And without the courage which you need, you cannot have war, not even economic war, without expenses on ammunition and other things. So as you continue to have these half-baked sanctions, you will have only very marginal abstract losses for Russia. In order to really have sufficient sanctions, you need to get to the volume question. And that means you need to be prepared to pay higher prices.
Well, what do you think, Chris? I mean, another point you could say the sanctions have failed, that actually Russia had a current account surplus last year. I think it was $227 billion, which was more than twice the previous year of 120. And that was already an all-time high. So Russia's actually almost replaced the whole of the 300 billion that was frozen CBR money, and was washed with all this cash coming in. And from that perspective, if the idea was to cut it off from the funding, then that failed. What do you think?
Look, it depends on what it depends what your expectation is, what your objective was. So for those who thought that sanctions would quickly bring Russia to its economic knees, cause a financial crisis, starve the cash flow, and therefore force it to pull back from East Ukraine, clearly that hasn't happened. And that has failed, if you like, if that was the expectation. But on the other hand, if the now sanctions are aimed at sort of long-term damage against Russia, in terms of containing or degrading the economy so that Russia won't have the same sort of economic progress as it was looked forward to previously, and therefore you have a slow degrading of the impact, then it's likely that will work. So in other words, it's
a new goal.
It's not going to have a quick. Yeah, I know it wasn't, but that's now what you're having to look at, because there is now we know that possibility or that's not going to happen, because Russia we're only talking about how much oil Russia will be able to shift to other markets and what will be the price of that oil. But we're not talking about Russia being cut off from cash flow or not having enough money. It will have enough money under any kind of a reasonable scenario. It will have cash flow. What you are looking at, though, is what is the kind of long-term economic damage in terms of, the economic progress and how that'll affect people. But that's years. There is no pressure today on the Kremlin to end this conflict because of economic pressures or social political pressures at home. That's gone. It's not going to have enough money to build massive bridges and to develop a technology sector or anything like that. The national projects, clearly not, but it is going to have enough money to sustain the economy, to continue stability. So yeah, absolutely. Therefore, unfortunately, I think if anybody's looking at this next round of sanctions, later round of sanctions, saying, okay, this is going to change the picture, and by the summer Russia's going to have economic pressures and it'll change, that's not going to happen.
It doesn't seem to be coming into the debate, because it seems to me that there's a real mismatch in so much as the sanctions are effective, that you've hobbled the long term. The economic growth potential of Russia is down to whatever it is, 1% now, long term, and it should be still an emerging market. It should be 6, 7, 8%. But the trouble is the damage that does will take, as you say, years to have an effect. Whereas Ukraine desperately needs help right now. It needs pressure on Russia now, because Chris, I think your note was saying that you think the big offensive could start tomorrow on the anniversary. And there's no sanctions that we can put on, or maybe there are some with the oil, cutting oil completely, that we could put on that would actually crash the Russian economy.
I think it's really also functions of the guts of the cost the sanctioneer is prepared to carry. If you address prices and volumes, you have more success. If you address only one, you have less success. But I think it makes probably sense to look at it from the other way and start at the military situation and understand the energy sanctions as a supporting tool. And then you can go with military analysts, and you have these two scenarios. One is Russia starts an offensive, gets at least the Donetsk, digs in and goes for a long entrenched phase, which may entail negotiations. And the other extreme, Ukraine has it his way and cuts off the Eastern Front from the Southern Front and puts pressure on Crimea, and Russia panics. And then you will see very, very different oil market outcomes, which you can discuss under these military scenarios. So that might be a more sensible way to go about it.
Okay. Actually, can I wheel back to Christoph? One of the questions you asked, I did ask that several times over the last year in Moscow about the discount, and it seemed, as you say, that Russia was emphasizing India and China and Turkey in particular as alternative markets. And what about the other markets, as you say, maybe you get a better price? And every time the answer was that was not under a consideration. That the priority, as you alluded to, was to create this kind of strong relationships. It could buy them, I guess, is maybe a better way to these relationships with countries like India and Turkey, in particular, in addition to China. That was the priority, and therefore it was not about cash flow. When the Russian oil sector is now effectively nationalized, it is not working on a commercial basis, it's working on a cash flow basis, and is selling oil to areas that suit the Kremlin. And the Kremlin's objective is to build these relationships with the new countries or with friendly countries, and therefore giving cheap energy in order to incentivize that and to therefore to broaden it is very much kind of their strategy. It's not about maximizing dollars for exports. It's about strengthening relationships with new countries.
That is a very important piece of information. And that was my suspicion, because the implication is that it becomes much less likely, pending a military catastrophe, for Russia to use oil as a weapon to bring about a recession in the collective West. Correct?
Surely the attitude to the oil sector now, I mean, when it was run pre-war, that it was about maximizing profits, it was a capitalist system. However, post-war, it's surely for the Kremlin, it's just a question about revenues. They don't care about profitability anymore. They just need to produce enough revenues in order to have cash to pay for all the things that they need to support the social, to stop public unrest.
It's not only that. Yeah, it's not as simple as that, as Christopher were saying. It's partly about having enough money to do what you need, and say funding the military campaign is a big chunk of it, but also providing enough money to ensure the domestic economy is ticking over. That means subsidies to state companies, ensuring employment and revenue, even though we're now hearing about more part-time working and some salary cuts, but ensuring that there's enough, and critically supporting key social programs like healthcare or education, etc. That's it. I mean, those are the objectives in the package, and as long as there's enough money for that, then really there isn't any pressure on the Kremlin.
I want to go on to
else. But the other priority, though, is absolutely, it's about cementing those relationships with countries in Asia and in Central Asia and in the Gulf, and using cheap energy to do it is a key part of the Kremlin strategy. And we will see a lot more of that this year. Already we're seeing it in Central Asia, as Russia's moving into Uzbekistan, Kazakhstan, etc., with cheap gas, etc. We will see more of that, using energy to cement those relationships and expand trade.
There's a very long tradition of that, though. I mean, Gazprom was always a state tool of foreign policy, and Rosatom is playing that role now as well, with the sale of nuclear power stations to Africa. Sorry, Chris, I jumped in on you. What were you going to say?
No, I wanted to ask Chris something. I wanted to ask Chris. No, I'm sure you know that there's this discussion now based on the January data, whether the discount has considerably come down. Some people, like the IAF, say that they make this argument based on comparing customs data from Russia with the published euro price, and they say it doesn't add up. So when you take actually the customs, the Russian revenues announced by customs, the euro's price must have been higher, or the volumes must have been larger. Some people make the argument that the discount has narrowed because the competition with other countries has led to an increase in the euros price, which is not in the Platts data. Where do you stand on that debate? And some people, including myself, would say, looking at all of this, it's only a one data point in January where there were all sorts of changes, including in the tax space. It's probably meaningless and probably not a correct statement to say that the discount has meaningfully shrunk. What do you hear from that, from where you're standing?
Yeah, no, absolutely. I think your last point is exactly what I've been hearing, and I've been checking a lot. And we do, macro advisory, we do double check data where we can, looking at trade data, for example, China and Turkey, cross-referencing, etc. And you have to do that to try and validate data rather than just accepting data points. But absolutely, I would say it's a data point. It's not a trend, because first of all, remember, there was a huge surge in buying Russian oil up to December the 5th. And literally the tanks in Europe are full, and in Rotterdam and everywhere else. They're just literally full. They bought as much as they could because nobody was going to know what was going to happen, coming into 2023. So building up, and that helped this windfall revenue that Russia earned. But the fact then that there was a big drop in oil demand, oil exports, and Russia had to cut prices to sell it to get rid of it is not a surprise. Also, even maintenance, Primorsk, and in the port out near Khodna, they delayed their autumn maintenance until December because they were so busy. So you had a 10, 15-day shutdown in Primorsk, you had a 10-day shutdown over in Khodna for maintenance. So all of these things, in other words, the December and the January data was always going to show a big drop because of this transition. And I think the same in February with products. As I mentioned, product exports to Europe are running at a record 2.8 million barrels a day, as basically all traders and all the buyers were filling up as much as they could ahead of the cutoff, and then wait to see what happens. So frankly, I think that it's a data point that may straddle the whole first quarter. We may not get a clearer picture of pricing and volumes until we get into, into March. That's what everybody keeps telling me.
But this running ahead of and stocking up before the cutoff point, that would indicate a widening of the discount after the cutoff point. Whereas in fact, what Goldman Sachs and IIF claim is a narrowing of the discount.
Yeah, no, it's a data point, but also remember it was all distorted because Russia did another stage of the so-called tax maneuver. Essentially, this is moving the tax on oil to production rather than export. So you had a complete distortion in a lot of the trade and customs data because of that as well. So frankly, it's just very difficult to use any of that extrapolation.
Can I ask both of you? To what extent is the euros price relevant at all? I was talking to Elena Rybakova to IIF, and she was saying the market's gone dark. People are not reporting anymore. A lot of the oil trade used to go through the European Primorsk to Rotterdam, and then that went through the Baltic Exchange, and the people were very good about reporting the volumes and the prices. But now they don't want to. People are because there's all these games, ghost ships, scams, and so they're not reporting. And that the discounts being reported, they're anecdotal now, that those agencies or the exchange is relying on ringing up traders and asking them for individual deals or, selective deals, and that the euros price is not relevant anymore. It's not actually the price on the market.
Her paper and a note from Goldman are the reason why I was asking Chris that question. And she makes this argument that when you track revenue data as reported by Russian customs, it doesn't square with the euros price. And so therefore the euros price must actually be higher than what has been in the Platts data. I think I agree with Chris, maybe for different reasons. I think it's not serious, this argument, because it's really just based on 1 month's data point. This is not true. At least we cannot state that this is the beginning of some trend. Independently of that, euros price, of course, is of limited relevance because all the ESPO exports to China, that's not part of the euros price and not part of the discount, but it is of relevance for India and for Turkey.
Isn't there another aspect here, in so much as that the sanctions with the cap, $60, applied to the FOB, the free on board price? And there's been reports that what's happening is that Russia's now set up all these services, and so that if the Indians buy Russian oil, they don't get involved with anything. They don't get involved with the shipping. They don't get involved with the insurance, and they have a an FOB price of whatever it is, $46. But then by the time the ship unloads and the price that the Indians pay at the end of the day, you add another $25, so that you went from $50 to $75, which was just a $5 discount. And that's all perfectly legal under the sanctions, because the sanctions specifically target the FOB price. Is that true? Is that another distortion?
Yeah, we are certainly hearing exactly that. There are so many different variants being talked about, and that's certainly one. And now, of course, we're hearing more and more information about all these kind of new tanker registrations, which have been opening in Dubai, which certainly are carrying Russian oil and plying that trade. And again, the pricing has just become completely vague. Actually, not to digress, but just in case of Urals, we certainly could be coming to the end of Urals, because the Russian Finance Ministry, of course, now wants to use Dubai price. There was a debate whether to use Brent or Dubai, but Dubai price is seen as much more relevant because, of course, the new customers, India, Turkey, elsewhere, maybe East Africa, of course, it's competition with the Dubai price. And so they're going to shift the tax formula to using Dubai crude as the reference point rather than Urals or Brent. So there's a lot of...
Is that because you can pay in dinar as well? Because there's already Indian deals that are being settled in dinar, which means you get away from the dollar.
The dinar is...
Yeah. Sorry, Chris, go ahead.
No,
I was going to say, yes, we're hearing a lot of, but the UAE dirham, of course, is where we're hearing a lot of the trades coming that way. Remember, of course, the UAE and Russia are old hands at this, because they both collaborated in the 90s, the Iraqi oil embargo, whatever. They perfected that scheme as to how to shift oil along the Gulf and out and get paid for it and move money around. So they're well practiced at this, although sometime back, but nevertheless.
There are sort of 2.5 observations which matter in that context. One is that if it's true that they switched from Brent minus 20, as they had announced to Mervan, then I guess it is the UAE crude benchmark, then this is certainly just like the discount to India and China, an attempt to keep the alliance alive, because the UAE was always very much interested, of course, in establishing a benchmark crude themselves. Secondly, the dirham is tied to the dollar, of course. So it's very easy to switch away from the dollar into the dirham, because de facto it doesn't change anything, but it diminishes as one step, in this long journey of getting things out of the control of the dollar as a reserve currency. And then the half observation is there's, of course, a very long effort also on the other side of China to pay for its oil from the Middle East in renminbi, for the same purpose, to get it out of the dollar orbit and to strengthen the renminbi's role as a reserve currency. And when you now see that Russia's liquid reserves are usually pretty much reduced to renminbi holdings, and that on the other hand, using the Dubai benchmark makes it possible to have dirham payments, then you can just see how that circle may close at some point. And the renminbi gets involved into the oil trade in this triangle between Russia, the UAE, and China. And all of that has to be understood, I think, as small steps towards an attempt to get an increasing amount of international relevant transactions. And oil is definitely in this category, away from the orbit of dollar denomination, and therefore from direct US control.
Can we switch topics and look again at the products, the February 5th ban on products, because it seems that the crude market has more or less remade itself, and India and China have taken up the slack. But with the products, my main question here is that you're sending crude to India and China, who are refining it. But with the products, then Russia has a lot of products, and that was much more widely distributed in Europe. And the thing is, they can't send those to India and China. And the Russian products now are in direct competition with the products that India and China are producing. And can the market actually absorb it? And this is all highlighted by this debate about the 500,000 barrel cut that Novak announced, although I just read that he's only going to do it for 1 month. And the debate is that they had to do that because they can't sell the product. or it could be that they can sell the product because they've already found new customers and they want to manipulate the price instead as a sort of a shock to warn everybody where it's going to go if things carry on. Chris, Christopher.
There's to some extent, crude was easy because it's a very, kind of, what's the word? Fluid, if that's not the right word. It's movable. But product is obviously very different. And first of all, the volumes are much bigger. As I mentioned, Russia was exporting 2.8 million barrels of product to Europe, which is now banned. And it won't be therefore easy to, we reckon that Russia might be able to send about 50% of that to other markets. And that's where this kind of drop of at least 1 million barrels of production under our scenario kicks in, because where are you going to sell that product? Now, we can see that there are some ways, again, we go back to the Emirates, because there is a get out of jail clause, of course, in the sanction, which says that there is that Russian oil can be blended with other products, and that's what Christoph was saying. You can discover where forensically you can see where crude oil comes from, but not products.
We've already seen that Turkey did massive spike in import in diesel. Morocco as well. Senegal, suddenly all these new players are coming in.
Yeah, absolutely. There's a couple of ports off Malaysia, off Turkey, and Fujairah. I mean, literally, you could, okay, this is going to sound stupid, but you could literally go out to a tanker with a barrel full of crude, barrel full of product from your refinery and throw it into a Russian tanker, and it technically qualifies, because there's nothing in the sanction that says X% has to be from somewhere else. It just says it has to be a mixture. And
so this makes the whole
mixture. You're seeing an enormous volume going through. So yeah, again, this is part of what I'm saying. We have to see how this blends, because some of those tankers that Russia's been using on the Baltic Sea and sending into Europe will not be able to go anywhere else. They're local tankers. So we don't as yet know how much volume Russia will be able to ship on other tankers to other markets. Even
but look. I mean, last year was a year with record refining margins, refining capacity stretched. Russia, as you said, is a big exporter of products. As Ben indicated, we're already seeing a huge amount of Russian imports going, for example, to the Middle East, and then coming out. Suddenly, the refineries of the Middle East produce a lot more products, which goes into Europe. And the icing of the cake is that it's not even illegal because of this provision that you can blend it. So I really don't see a problem in the medium term of adjusting the product flows. I think, if anything, this will be more straightforward and easier and more profitable than it was the case for crude oil.
So the 500,000 barrel cut is a price thing. It's not because they can't find customers.
I don't know. This is a very important question. For a price thing, it's not large enough. It's not threatening enough. I think this is both. This is a bit of testing flexibility and an attempt to smooth the transition. We know how it will play out, but markets take a few months probably to do this. New tradeways and all that has to be, new blending facilities has to be established. Oil refining is much more of a process than just storing crude oil. So most likely, I think at this stage, it was just a measure to buffer the prices where they are.
Isn't this like Chris was saying? I mean, at the beginning of the conversation, that it's like the beginning of the war, and then the traders wouldn't touch Urals, and then it took a couple of months for the market to do its thing, and now we've introduced a new distortion, which is the ban on products, and so now everybody's scrambling to work out the new routes, and the collapse in oil revenues as well. I think is related to that sort of disjoint that just happened, but it'll take several months. And with these new players like Turkey, Morocco, Algeria, Senegal, who are taking the diesel, because we've got the problem that it takes 2 months for the tankers to go there and come back. And so we actually haven't had enough time. It'll only be next month or the month after when this new system is starting to operate smoothly.
Yeah.
It will take time, but it will not be a fundamental problem. That's my point. And they bridge the time by having this temporary cut, which also, they're in a strong position because they know better than anybody else at the end of the day how the new flows look like. And this will likely make it much easier if the point comes where you want to cut to influence prices, to be able to fine-tune these cuts much better than before the war, when everything was exported everywhere with a big shotgun approach. Now you can target it much more precisely, should this come. But the signal for this kind of interference in the markets, if Chris and I are right and they're trying to carry political favors by their oil policy, the signal for that would have to come from a pretty drastic defeat or problem on the military or political front, not from energy markets themselves. That's important.
Yeah, and actually, there's one other point as well to introduce here, which is that, as you say, suddenly we have all these kind of countries with major refineries that we never knew about before, Senegal and the likes. And the question now, of course, is back to what you were saying, Ben, earlier about how much pain Western economies are willing to take, because, for example, we know that the US Treasury has become very active in traveling around as India and the Gulf and Turkey and elsewhere in Central Asia, kind of essentially warning countries not to help Russia avoid or evade sanctions. So I don't mean sanctions busting, but helping Russia to kind of evade the sanctions and keep the. So the US Treasury, of course, does have the mechanism. It has the muscle to come down quite heavy and to put pressure on countries to stop cooperating with Russia. But if that were to happen, then you would have an enormous spike in the price of diesel and petrol and other kind of gas station prices across Europe and probably in some parts of the US as well. So, if
does it really have the muscle though? So look, let's talk about the budget, the revenues.
Well,
because
we have seen them.
Well, there was a collapse.
We've
in the
seen
revenues.
the US. I mean,
look, my point was with the budget, the 11 months of surplus last year with a bit of jiggery-pokery in November and Gazprom. However, the revenues collapsed by almost 4 trillion in just December, and we started January with a deficit of whatever it was, 1.8 trillion rubles, about $40 million bucks, no less than that, 20 million bucks. But then, if this market, that would imply that the deficit for this year, at the moment, the official position is like 2 trillion rubles deficit this year, but we had almost 2 trillion just in January.
Yeah, no,
and then don't make this mistake, Ben. But this is when you compare January 23 with January 22, right? What you see is in 23, after the December adjustment, oil prices coming down, exports stabilizing. What you see in 22, everybody trying to get as much oil as possible, prices being sky. When you compare that, even not even looking at the revenue and the tax-based discussion side, then what you see is this: you just have an exceptional bad month, and one shouldn't extrapolate from that easily for the rest of the year. I really think
because
this would be
people are using that.
There are two other
say
factors
the sanctions are working. It's the pain you were talking about.
No, that is wrong. That is absolutely wrong. It drives me crazy when people indulge in what I'd call political economics, where you start off with what you'd like to achieve and then try to be selective with the data to prove it. It is simply not the case in January. In January, we had a couple of unusual factors which won't be repeated. First of all, there was the adjustment in the tax payment system.
Yes.
The finance ministry went to a one date unified payment, and they said before January and repeatedly January that the revenues because of that may be delayed into February and that it could be a couple of months before it smooths out. And we did see a big drop in things like VAT and excise, which can be directly linked to that tax maneuver, and they will reappear. There'll be a big surge in revenue in February or March. It'll just be the smoothing out of the last January numbers. Also, there was a big allocation of spending in January that wasn't expected in January to come. What else going to be for? And again, that's not going to be repeated. And then the backdrop we've been talking about is this distortion in exports and in reporting and kind of all of the games that everybody's been playing on. So absolutely 100% agree with Christoph. You cannot use a data point, 1 month's data. It will be February, March before it smooths out. And the finance ministry had a long chat with the deputy minister last week about that. And he was also throwing his hands up saying people are not listening to us. They're still confident that their forecast for the budget deficit this year is on track. And those distortions will be smoothed out by the end of Q1. That's what he told me. So we have to wait and see, but it makes sense what he said rather than assuming it was a disaster in January that'll be repeated.
So we're looking at something around 2% of GDP deficit, and given the money, the 85 billion that's, or 7 trillion that's in the National Wealth Fund, plus the 3 trillion of OFZs they're planning to issue, there's plenty of money to finance that gap. I mean, Russia's probably got enough money for 3 years at that kind of deficit.
That's exactly what we're saying. That there's no prospect of collapse or financial collapse or anything that puts economic or social pressure on the ground.
You start these sanctions with this big bang on the financial sector side. You sort of go by tightening up everything until, as the coalition I'm talking about, until you're really cornered and you need to address the energy question. You start doing that, but then you shy away from it a little bit. You don't want to be too drastic because you don't trust your own ability to withstand higher oil prices, despite the positive experience of Europe and the gas markets. And that's where your question comes in. If you're not willing to take more pain, then you should not expect the sanctions to do more on the energy front. Nevertheless, because the global situation in energy is one, no matter what the Goldman Sachs of this world say, a tendency towards excess supply and not excess demand. You see distortions and then it coming down, and distortion and coming down always again and again. Nevertheless, Russia will at least not sort of explode its revenues endlessly. And while it's still able to make these kind of political deals and to try to form an alliance with giving a carrot to the Indias, Chinas, UAEs of this world, which is to get themselves a little bit more independent out of the US dollar orbit into this multipolar world that many people are talking about. But in order going forward, in order to expect something different from energy markets, you would have to either tighten the sanctions considerably, including Western pain in the form of higher oil prices, or the more likely scenario, you have to concentrate on the military situation. And if Russia is in dire straits there, because, for example, the Crimea is threatened, then it will use oil as a weapon and in the course of that destroy a lot of things. Because have you heard this expression, poly crisis? People talk about a crisis here and there rather than one crisis after another. And the common effect of these crises is worse than it's one historian, but Russia's mindset is still much more in a Wagnerian scenario at the end, than to burn the bridges, all of them.
We're coming into the home straight, and there's one important topic I want to briefly touch on, which is the ghost fleet. My question is, like, how many tankers actually are there? Because I've seen anything between 100 and 600. And in theory, Russia can just dodge the sanctions completely. But is the capacity of those ships enough to carry, say, all the product, the 2.8 million barrels? Chris, I mean, you mentioned like infrastructural bottlenecks, because there's also the Greeks are playing a role here, and Twitter's filling up with all these geolocated tankers that are just sort of hanging out off the coast of Greece and clearly doing ship-to-ship transfers. And with the blending, it means that you could probably get most of that oil blended and in a ship-to-ship with an EU company, and at the same time take the rest on your own tankers.
Yeah, no, absolutely. I mean, when I said about our scenario where we expect 1 million barrels drop up to 1.5 million, the number of tankers that have suddenly appeared is an enormous surprise. I mean, who knew there were that many tankers around the world that you could get hold of? It's certainly in the hundreds. As to whether it's closer to 200 or 500 or 600, we simply don't know yet. We will know in a few months' time when we see the volumes, but right now we don't know. But there's a heck of a lot. There's an enormous amount, and as you say, there's a lot of ship-to-ship transfers taking place, and that's the way it will go. So yeah, look, I don't have an answer to that. You could certainly figure out the crude flows better because it is easier. The refined product will be more complicated in some ways, but it'll come down to as much pain, say, Western economies want to take. For example, if they were to block this Suez, for example, transit, or cause that to be blocked, unless ships had some, paperwork, whatever, to prove it wasn't Russian, that would block the trade. But we would double the price of gasoline at least in European prices immediately. So it really, I think it's the same thing over and over. If Western economies want to limit the damage to their population and to their economies, then they cannot fully enforce They can make life difficult for Russia and add transaction costs, but they
The way
cannot
you're
afford.
talking, it sounds like the products, it sounds like a bit of Swiss cheese. I mean, don't you need to introduce something like blood diamond documentation on the origin of the oil? At the moment, there's nothing like that. And so you're free to have all these scams.
Yeah, well, you can choose to buy a diamond ring if not, but you pretty much have to pull in and fill your tank with gasoline and diesel very often. So I'm not going to say it's different this time, but yeah.
It comes down what we said earlier. So it's difficult, technically more difficult than dealing with crude, therefore it will take longer. But without further sharpening of the sanctions, it will settle in and happen. The other way around is an interesting question. Just as the West, collective West, could tighten sanctions specifically to make life difficult for product export, so in the future, Russia could use these new complicated ways of product exports, which will emerge, to cut them in order to drive up prices at the pump without even using the crude oil market to that extent, in a much more direct way. That's a bit the fear here when they decide to use oil as a weapon, that this complicated trade network, which now is being established, could actually be abused more easily than what we had before.
Because aren't we, at the end of the day, with all these distortions or sanctions that have been introduced, I mean, we're now engaging, we've taken one of the biggest and most efficient markets in the world and introduced massive distortions. And then to enforce that, isn't this just going to turn into a huge global game of whack-a-mole, where the states are flying around already and having meetings in South America or Latin America, South Africa, trying to get people on board. But in order to, every time they come and whack the mole with one of those meetings, then it's possible to make a new game. You know, you go to the Senegalese, or you do a deal with
That's the sign of an efficient market. Then what happens? What follows from there is something else, which is rarely discussed. At some point, the war will be over. Not necessarily with a peace treaty, but in the sense the shooting stops. People will no longer refer to it as a war.
I think that the bottom line then is that expect this what we see.
European blighted by weapons of mass. I don't know which scenario, but we know a few things which will happen next. And one of them is a big downturn in commodity and energy prices as the cycle turns and as all these distortions get back to normal, as you assume that Russia remains on this planet and remains a big exporter. Another thing which we know is that many governments in the Western world will be poorer and debt levels much higher, in particular in Europe. The third thing which we know is that because of rising CO2 emissions and all the other failures of the energy transition, this transition will now have to proceed faster with less financial means, so good days for carbon pricing. So that is a direction where we can make use of these developments to work out some trends that hasn't happened yet.
Okay.
I don't know why.
Chris, last few minutes, go on, you can sign off. What do you think?
Okay. Let me say two things. One is that I think what we now know is that the sanctions in the oil market are not going to bring an end to the conflict. They're not going to put pressure on Russia. There's enough ways around that for Russia to continue with a different economy, but to continue and just adds costs. It adds costs to Russia. It adds costs to Western economies. But the oil sanctions, which a lot of people thought would be the deciding sanction to bring Russia to its knees, clearly is not going to happen. And there was one question from John Schiffer, if you wouldn't mind. I just asked, well, Paris Siberia 1 and 2 are only gas pipes, they're not oil. It'll get up to about 40 billion cubic meters. And Paris Siberia 2 hasn't even got to the drawing board yet. Best case scenario is that Paris Siberia 2, if built, will probably be almost at the end of the decade, but about 50 BCM. But also that's gas from the Far East. It does not offer an alternative for the gas that has been going to Europe. It can't switch to Paris Siberia or 2 when it's ready, because they're different parts of the country. So we could talk another hour about gas, but clearly gas is not something that Russia is able to shift to any of the markets for years and without billions of costs. It's quite different to oil.
We'll have to do another one of these sessions on gas, which is a whole different kettle of fish. So guys, we've run out of time. So I'd like to thank you both, Chris Weafer and Christoph Ruhl, very much for joining me yet again. Absolutely fascinating, big, complicated subject. And I think we need to reconvene in about 2 months' time when all the tankers have gone to Asia and come back again, and we actually have a sort of regular flow and see where we stand. To everyone out there listening, thank you very much for attending. Again, I point you to bne.eu/welcome. Have a look there. You can find links to our YouTube channel, to our Editor's Picks Digest, and various other goodies. Try the Pro service if you're interested in all of this. We write about it every day. So until we meet again and have our next webinar, thank you again for joining us. Thanks again to my guests. Goodbye from me.
Okay, thanks.
Thank you. Thank you.
Thanks, guys.